Something unusual just happened in the precious metals market, and if you own gold or silver, you need to understand it immediately. Gold has broken below the $5,100 level, and silver has been collapsing at an even faster pace. This isn't a routine pullback or a mild correction. Silver plunged from roughly $96 to under $80 in only a few hours. Moves like that are extremely rare in this market, and they usually signal that something much bigger is happening beneath the surface. What's important to understand is that this type of decline rarely ends in a single day. When markets start moving like this, it often means a chain reaction has begun. In this video, we're going to break down what may be driving the sell-off, why silver is falling even faster than gold, and what similar crashes throughout history can tell us about what might happen next. Before we get into the mechanics of the crash, I want to address something openly. In my previous analysis, I suggested that the $85 to $86 area could act as a strong support level for silver. That level didn't hold. When silver reached it, the price didn't stabilize. It fell straight through it. When a support level collapses that quickly, it tells us that selling pressure in the market is much stronger than expected. However, there was another level that did play out almost exactly as anticipated. Weeks ago, I pointed to the $95 to $102 zone as the area where silver could form its next lower high before a potential downturn. Silver peaked near $96 before this latest drop began. The significance of that lower high is that it signals a potential shift in the broader trend. When markets start forming lower highs instead of higher highs, it often indicates that momentum is weakening. Now let's look at what happened with gold. Earlier, gold surged upward and briefly approached the $5,400 level. That level was extremely important because it represented a major resistance zone. If gold had managed to break through it convincingly, the market could have pushed toward new highs. Instead, the opposite happened. Gold touched that resistance area and then quickly reversed direction. At first, the decline looked like a normal rejection from resistance, but instead of stabilizing after the initial drop, the selling continued. Gold slipped past $5,200, then below $5,100, and continued losing ground. When a market falls that quickly after testing a key resistance level, it often signals that large positions are being forced out of the market. Silver's drop has been even more dramatic, and that comes down to one important factor: leverage. Historically, silver tends to amplify gold's movements. When gold rises, silver often rises faster, but when gold falls, silver tends to fall much harder. A relatively modest decline in gold can translate into a much larger percentage drop in silver. That's exactly what we're seeing now. Gold has pulled back significantly from its highs, but silver has experienced an even steeper collapse. This isn't unusual during volatile periods, but the speed of the move suggests something more than just ordinary profit-taking. One possible explanation involves liquidity in the financial system. Recently, billions of dollars were drawn from the Federal Reserve's repo market, which is essentially a short-term lending facility used by banks and financial institutions. When institutions suddenly tap this facility for large amounts of cash, it often means they need liquidity quickly. In other words, someone somewhere may be scrambling for cash. When that happens, investors sometimes have to sell assets, regardless of whether they want to or not. If leveraged funds begin receiving margin calls, they must either deposit additional capital or liquidate their positions. If they can't meet those requirements, brokers automatically close the trades. That forced selling pushes prices even lower, which can trigger additional margin calls across the market. The result is a cascading effect where selling feeds on itself. Prices fall not because investors suddenly changed their long-term view, but because leveraged positions are being unwound. This type of chain reaction has happened many times in financial history. During the financial crisis in 2008, gold dropped sharply even as the global economy was unraveling. Silver fell even harder. At the time, many people believed the precious metals bull market was finished. But once the forced liquidation phase ended, gold and silver entered one of the strongest rallies in their history. A similar situation occurred in 2011 when silver crashed from nearly $50 to the mid-20s in a matter of weeks. Leverage in the market had built up to extreme levels, and when margin requirements increased, traders were forced to sell rapidly. The collapse was dramatic, but it didn't permanently destroy demand for the metal. Even in 2020, when global markets panicked during the early stages of the pandemic, gold initially fell alongside stocks and other assets. Investors were liquidating everything they could to raise cash. Yet within months, gold reached new record highs. These historical examples reveal a common pattern. In times of extreme financial stress, almost every asset can fall at the same time, even those traditionally viewed as safe havens. Liquidity becomes the most important factor in the market. What makes the current situation even more unusual is the disconnect between market prices and geopolitical developments. Normally, heightened global tensions and disruptions to energy supplies would push precious metals higher, yet the opposite is happening in the short term. When markets behave this way, it often suggests that positioning, not fundamentals, is driving the price action. Another interesting development is the difference between paper markets and the physical metal market. While futures prices have been declining, reports indicate that large quantities of physical silver are still being demanded for delivery. When institutions accumulate physical metal during price declines, it can signal that stronger hands are stepping in while weaker hands are being forced out. In other words, the market may not be collapsing, it may simply be undergoing a violent shakeout. That distinction matters. A broken market is one where buyers disappear entirely. A shaken market, on the other hand, still has buyers, often very large ones, accumulating during periods of panic. Right now, the biggest question is whether this wave of forced selling has finished or if more volatility is ahead. Historically, the end of liquidation phases tends to follow a few recognizable signals. Prices usually stop falling in a straight line and begin moving sideways for several days. Trading volume gradually declines as the panic selling slows down and stress in funding markets begins to ease. Until those signs appear, volatility can remain extremely high. For investors watching their portfolios fluctuate wildly, it's important to remember the difference between short-term price movements and long-term fundamentals. The amount of gold or silver in a physical bar doesn't change when the paper price on an exchange moves. What changes is the market's short-term perception and the positioning of traders. Throughout history, the most dramatic price swings in precious metals have often occurred during periods of global uncertainty and financial stress. And more often than not, those swings have been driven by leverage and liquidity rather than a sudden collapse in the underlying demand for the metals themselves. So the real question isn't simply where prices go tomorrow. The bigger question is how the market looks once the forced selling eventually runs its course. Now I'd like to hear your thoughts. Do you think gold and silver are close to finding a bottom, or do you believe this volatility has further to run? Share your perspective in the comments. And if you found this breakdown useful, consider sharing this video with someone who follows the precious metals market. Understanding what drives these dramatic moves can make a huge difference when markets become this unpredictable. Because sometimes the most important thing to remember during a crash is this: the price on a screen can change in seconds, but the underlying reality of the metal itself changes much more slowly.